We have been living through an incredible stretch in the last few years in the stock market. And I'm not joking when I say there are people out there who genuinely believe that stocks only ever go up. And honestly, I don't blame them for feeling that way. That has been the experience recently. But here's the truth you probably don't want to hear. There is a trap in the stock market that is waiting, not just for those investors, but for anyone buying blindly without understanding what they own. And when the music stops, because it always does, the people caught in that trap are going to lose a lot of money. Let me tell you a story. Back in the early 2000s, there was a guy in my hometown who managed a couple $100 million. His name was Bill. Now, Bill was a seasoned investor. He'd been around a long time. He wasn't dumb. He wasn't reckless. They were actual investors at this money management firm. They picked individual stocks. Tells me a story one day that one of his biggest clients, a guy with $10 million with him, had come into his office and said, "We are missing out on this tech boom." The boom was going so crazy that when he wrote letters to his investors, he stopped comparing his performance to the S&P and said, "Listen, everyone's focused on the NASDAQ and it's going to hurt us in the short run, but we're going to compare our performance to the NASDAQ." And investors were upset. Several investors came to the office and said, "I want out." One investor took some money out. He wanted to remove all 10 million bucks. Bill convinced him to take out half. He took out $5 million, invested in the NASDAQ. 2 years later, he brought back of that $5 million, $2 million was left over. Now, Bill is not one of those petty guys. He was happy that the guy kept half his money with them and took the other half. But money was being made so easily. Everywhere people looked, they were getting rich. In fact, another story I had was after the crash in college, a kid I knew who was in my grade but several years older, I said to him one day, I said, "Why are you 3 years older than me in my class?" He said, "Well, I left high school and joined the internet craze and became a broker." I said, "How was that?" He goes, "Paul, we literally would be pissed if we bought an IPO and it didn't go up 300% in one day. We would literally be pissed off." And we thought that that was the new way of the world. The internet had changed everything. The internet has changed everything. All of these companies, the tech boom that happened back then, imagine how different life is now versus 25 years ago, all based on the foundation that was established from 95 to 2000. If you think for a second that AI is different than the internet, no, it's the same thing with a different character in it. AI is a different character, and AI will change the way in which we live, just like the internet did. And Bill, this smart guy, he said, "We just knew this wasn't going to last." And everyone called him crazy. "Oh, Bill, you're just an old guy. You don't get it. The world is totally different now, blah, 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 blah." He was in his mid to late 50s during the late 90s. Now, interesting enough, though, back then I bought into the hype. So part of me was like, "Really? I just still think you're wrong." And I said something to him that day that actually now I look at and say I was correct, but I was correct for the wrong reasons. And I said to him, "But shouldn't these tech companies get a higher valuation because they can make $1 of profit a lot faster than these other old school companies?" And he said, "Maybe." Well, in actuality, that is correct. These tech companies have higher returns on capital. For those of you who are new, that means that if they invest $1 billion into their business, they can generate a much higher percent of that into profit continuously than the companies of 100 years ago. 100 years ago, in order to make money, you had to build factories, you had to hire thousands of people, you had to spend so much money to make money. Nowadays, look at Instagram, look at WhatsApp. These companies had a few dozen people when they sold for billions of dollars. It's much easier to make a lot more money today. But does that mean that any price should be paid for those? No, of course not. So guys, Bill's client bought into the hype, bought into all these things, said it was different, and he bought $5 million worth of stock, and very soon thereafter only had $2 million left over. That's the trap. It's not just that markets fall. It's that most people don't know why they bought in the first place. If you don't know why you're going to buy, you're going to sell at the smallest piece of panic. They don't know what to do when prices drop. Now, fast forward to today. AI stocks are flying, but everybody forgets. What did we have a few years ago? EV stocks were flying. Cannabis stocks were flying. Your buddy at work is bragging about the easy money being made in AI. YouTube gurus are screaming about the next NVIDIA. It feels like the internet bubble all over again. It feels like every bubble all over again. And overall for the entire market, the numbers are crazier today than they were in 2000. And this is what I keep hammering home. Yes, I know I sound like a broken record, but valuation matters. Price versus value always matters. Just like you go to the store and you want to buy more than you're paying for. You want to get more than you're paying for. Same thing in investing. You should try to get more than you're paying for. The best part about investing is you get to rely on the fickle and emotional person in the market. Those people will drive stocks up and down like crazy and very quickly. Now, we had a small bear market in 2022. And right after 2022, what happened? The market bounced back so quickly that people forgot that valuation matters. And that keeps becoming the repeat lessons that people feel they're learning. Market drops, markets go right back up even stronger. And it does for a while. The question is, when the music stops, what happens? And the problem we have is, by literally almost every major reliable metric in history, we are not just overvalued, we are massively overvalued. This is my stock market to GDP ratio. This is called the Buffett indicator. Why? Because Warren Buffett has said, famously, the best reliable indicator at any given moment is the stock market to GDP ratio. Now, I went and applied this to the S&P. I did it based on an S&P because it's a market cap based index. Historically, this goes back to 1900. And when the number gets too high, future returns are bad. And that makes sense, right? The future is going to create whatever it's going to create. The money created in the future is going to happen. Whatever price you pay today, it's likely going to generate the cash flow it's going to generate. So if I told you right now that for the next 10 years, I'm going to give you $1 per year. Very simple. $1 a year for the next 10 years. If you paid $1,000 for that, are you going to do well? No, you're going to do terrible. If you paid $1 for that future stream, you're going to do very well because you're going to take $1 and get 10 back, a profit of 9. If you pay $1,000, you're going to lose $990. That's the point. The more you pay for a future stream of income, the worse you do. The less you pay, the better you do. And right now, the future returns are not looking good. We are flashing a big warning sign. Guys, historically, the correlation between this ratio and returns is negative 0.82. Guys, this number ranges from -1 to 1. 1 being a 100% positive correlation, -1 being a 100% negative correlation. Guys, negative 0.82, if you ask any statistician, is extremely correlated. What that means is the higher the ratio, the worse the returns, and vice versa. Very simple. And right now, we're 119.26% overvalued. Fair value of $29.50 on the S&P, less than half today. And guys, look at this. Going back to 1900, when we're undervalued by 30% or more, returns, not including dividends, have averaged 10.7% a year for the next 10 years. Dividends get added to that. When we are 50% overvalued or worse, the average return is negative 2.3%. And guys, we're at 119% overvalued. Isn't it ironic? And for those of you who say this metric doesn't matter, as you get overvalued, what happens to returns? 10.7, 9%, 2.1, negative 1.1, negative 1.8, negative 2.3. It just makes sense. Now, of course, there are going to be people out there who say, Paul, stock market GDP doesn't matter because so much money's made overseas, blah, blah, blah. Fine. Let's look at the Shiller 10-year cyclically adjusted PE ratio. What this does is it takes the entire S&P earnings, no matter where it's earned, for the last 10 years, brings it to today in today's dollars, and gives us a metric. Let's check that out right now. Now, guys, the 10-year cyclically adjusted PE ratio is just as bad, 119% overvalued. It's at 39. During the dot-com bubble, we got to 42 to 44. So this metric isn't as bad as the dot-com, but the historical average on this is 17 to 17.5. We're at 39. Guys, stock market GDP, 10-year cyclically adjusted PE ratio, price to sales ratio, you name it, the ratio is screaming problems. And here's the part people hate to hear. Eventually, the market will correct. Not maybe, not if, not, well, it could be avoided. It will, because that's what markets do. People's emotions change. If you don't believe me, go look back at the internet. The internet literally changed the world, and we still had a crash. People are still going to be people, and they're going to be greedy. You look at a company like Amazon. Amazon is a company that could not miss for years and years, and its profit is up huge. But you know what's interesting? This is the 5-year chart. And for a big chunk of it, it was pretty even. From the middle of 2021, 175, and as recently as April, it was at 175. April of 2025. 4 years of the stock going nowhere for a company that's profit and revenue increased during that exact same time. 469 in revenue to 638 billion, 670 recently. Guys, this is what I always tell people when valuation matters. If somebody says to me valuation doesn't matter, I say to them, great, then let's add a zero to your investment. Is it still a good price? Well, no, I don't know about that. But yet when the price goes up that high, it's crazy. Now, I own 28 companies or so today in the stock market. If I take every company I own today and add a zero to the stock price, guess what? I ain't buying it anymore. But if I take a zero away, suddenly they're probably the best deals of my life, and I would sell my entire family's lives into slavery to get the money I need to buy these companies. Same companies, same products, same future, different price. That's what makes an investor an investor. When the price changes, you change your thesis. Price versus value is everything. It's the only thing separating speculators from investors. Guys, in 2000, Cisco Systems was the darling of the stock market, the must-own stock. There was an article written when it hit $500 billion in market value. They said this is going to be the first trillion-dollar company. And guess what? It was a great business. It is a good business. How do I know this? Guys, back in 1999, Cisco Systems did $12 billion in revenue. Today, $55 billion, up 4.5 times. Profit was $2 billion in 1999. Today, over $10 billion. That's a 5x growth. This is the stock that could not miss. You had to have it or you were stupid. Here's what's crazy. Guys, all-time high was March 27th of 2000 at $82 a share. It has not hit that price since. Even though revenue is up 4.5 times and profit is up 5x. You know what's crazy, guys? It's not like the company is selling for a super cheap value today where you go, well, it's only selling for 5 times earnings. Guys, it's selling for 21 times free cash flow and 27 times earnings. Now, guys, I've mentioned this before in the video. Fast forward the last 5 years. Electric vehicle stocks exploded. Paul, electric vehicles are changing the world. Tesla's changing the world. Nikola's changing the world. Lordstown's changing the world. Fisker. Everyone was rushing to fund the next Tesla. And where are those companies now? Bankrupt. Gone. Investors lost billions. Not all of them. Tesla's still around. Lucid's still around. Rivion's still around. But where are their stock prices now? Even the ones that have made it have been struggling. Go even further back. At the start of 1900s, there were over 2,000 car companies in America. Today, only a handful have survived. Same with airlines. Tons of hype, constant bankruptcies. And guys, actually, if you look at all the money invested in airlines from the start of airlines to today, they've actually lost money. Now you might sit there and say, well, that doesn't make sense because guess what? If I went back to 1900 and told you airplanes and cars, look how many airplanes and cars we're going to have in the next 125 years. You'd have said, this is a great industry to be in. But it harps on the fifth and most important tenet of our principle-driven investing. A great story can become a bad investment if you pay the wrong price. Real estate. How many times have we heard real estate builds wealth? And of course it does, but not at any price. And before 2008, people were paying any price possible because real estate never goes down until it did. This pattern repeats over and over. When people ignore valuation, bubbles form. Remember, bubbles are started on a very sound and logical premise that's then taken to an extreme. And when bubbles pop, everyday investors get crushed. So what should you do as the everyday investor? Lesson number 1, always stay invested. Don't time the market. Ride it out. If you bought the QQQ, the NASDAQ 100, right at the top of the dot-com bubble in 2000 and just kept buying every single month, reinvesting your dividends, you would have seen an 80% drop to start, But as of today, you'd have over a 14.5% annualized return on your money, even with that 80% drop. Even if your timing was the absolute worst it could have been. That's how powerful consistency. That's how much it pays to ignore the noise. Lesson 2, don't buy blindly. If you're going to buy an individual stock, just because it's going up, you don't know why you own it. And when it goes down, you're not going to know why or when you should sell it. That's the trap. Lesson 3, focus on fundamentals, cash flow, debt, margins, valuation. That's what you need. You don't need a PhD. Guys, you have an amazing advantage by being an everyday person who doesn't have to make anybody, any investors happy. You have to just focus on yourself. You just need to treat buying a stock like you're buying a business or buying an iPhone. You wouldn't pay triple just because your neighbor bought one. So why are you going to go pay triple for anything else you do in your life? When you go to the store, you don't sit there and say, hey, this shirt's worth $99, but I want to pay you $150. If you don't do that in the store, why are you doing that in the stock market? Because there's a lack of understanding. And a lot of our viewers that we've learned about early on in their process, they don't realize that when you buy a stock, you're buying a piece of a business that you can value on your own. It seems intimidating. It's not. The hard part is the emotional side. That's why we have this channel. That's the benefit that you have to everybody else in the past. And I'm going to say this till I'm blue in the face until the day I die. Valuation absolutely, without a doubt, matters. Price versus value matters. If you're paying more than value, you're going to get hurt. It's not about being a pessimist, guys. It's about being prepared. Look at Warren Buffett. He's probably one of the most optimistic people that ever existed, especially about the US economy. He's not a pessimist. He's an optimist. He's just intelligent about it. I'm not going to change my message just because the market feels exciting, just because all my friends say, oh, Paul, you missed out. I change it when the numbers change. I change it when the facts change. Nike was not a buy at $180 a share. And we made videos about how we'd be interested under 100, and people thought we were crazy. The ironic part is it falls to $70, $75 a share, and it makes sense to me. And guess what? Same company, different price. I like it. Now the masses who loved it at 180 hate it at 75. Does that even make sense? Hopefully you realize that doesn't make sense. And they've taken a hit in revenue. But I asked the question, will Nike be a declining business for the next 20 or 30 years? Or will they figure it out? That's what principle-driven investing is all about. So let's go back to that Buffett indicator and the 10-year PE for a second. I do believe that those averages should go higher over time. As I told you before, 100 years ago, if you want to make money, you have to build a huge factory, hire a bunch of people. It took a lot of capital to make money. Today, as technology becomes part of every single business, it'll take less and less capital to grow revenue and profit. So I do believe there should be an increase in the overall valuation of the market. But how much more? That's the question. Ironically, in 1929, almost 100 years ago, valuations were as bad as they are today, and we saw the Dow Jones fall 86%. Guys, I've said this 1,000 times on this channel. The next 10 years are unlikely to be as good as the last 10 years. That's okay. I know you and everybody else, even myself, I don't want to hear that. I would rather be able to say, hey, the next 10 years are going to be incredible. And guess what? There will be a time on this channel when I say those exact words. And guess what will happen? The market will go down even more, and people will say, Paul, you said the next 10 years are going to be great. I said, yeah, the next 10 years. I don't know about today. I don't know about tomorrow. I don't know about this year. But if I'm able to buy great companies at better prices with a lot more potential, that's what I want to hear. 25 years ago, I didn't want to hear that either. I wanted someone to tell me it is different this time. It always works. But reality doesn't care about what we want. That is why I'm hammering this point home. If you want to be a long-term investor, you have to accept valuation. You have to learn how to separate hype from value. So here's the bottom line. The stock market today is a trap for people who buy blindly. If you know what you own, why you own it, if you looked at the cash flow, the balance sheet, the price you're paying, and you understand that there is a price that's too high to be paid, you're probably going to do well or on your way to doing very well. You're going to thrive as you get better. But if you're buying just because stocks always go up or you have FOMO because other people are making money, that's not investing, that's gambling. And at the end of the day, gamblers will always lose in the stock market. So guys, if this connected with you, I mentioned our principle-driven investing. It's a great way of thinking about investing and money. I really Love this. I think it's something that I look at every single day and think about every single day. So if you want our free, absolutely free PDF where it explains all 5 tenets, it talks about the thought process that I go through when I think about investing, whether it's stocks, businesses, real estate, whatever it is. It's simple, it's clear, and it's going to give you the confidence to know why you own what you own and how to think for the future. And if you're serious about building wealth through investing, don't just stop at the PDF. Guys, I personally picked 7 of my own stocks to compete against the Magnificent 7 earlier this year. I saw the Magnificent 7 and thought, this is overhyped. I picked these stocks, and there are 7 stocks that I currently own because I believe their future is a lot easier to determine, and they're selling for valuations that make sense. I've put this head to head. I made a video, and guys, what's interesting to me is it's only in the short run, but my stocks have done quite well. So if you're interested to see how well they've done, click the video on your screen to watch it. The results will surprise you. Thank you for your time.